The next important component that we're going to discuss are moving averages. We need to understand why we use moving averages, what they are, how they impact our trading, and how we use them to our advantage day in and day out. There are two primary types of moving averages. One is the simple moving average, and this is the one that we're going to use and we're going to become familiar with, and I'm going to explain further. The other type is called a weighted moving average, or WMA. The simple moving average, or SMA, is calculated by taking a series of prices or reporting periods. So, for example, a reporting period can mean a series of 10-minute bars on a 10-minute chart, or 60-minute bars on a 60-minute chart, or daily bars on a daily chart. And bars are candles, and sometimes you'll hear me interchange the two terms. So either 60-minute candles or 60-minute bars means the same thing. When you add these prices together and then dividing the total by the number of data points gives you the moving average. You don't need to be concerned with this because the moving averages are going to be drawn on the chart when we put them on the chart, and they act as a guideline for us, and we'll see that in a minute when we go back to the charts. The weighted moving average is different in that it uses values that are linearly weighted to ensure that the most recent prices have a greater impact on the average. We don't want that, so we're not going to use the weighted moving average. We're going to stay with a simple moving average, which will be most helpful to us in our trading and analyzing the charts. We're looking at a 10-minute chart, and you can see three lines on the chart: red, blue, and black. On my chart, the red line represents a 20-period moving average, a blue line represents a 50-period moving average, and a black line represents a 200-period moving average. If you've read any books on trading, then you've likely seen other analysts use other types of moving averages. Some will use a 9-period moving average, some will use a 100-period moving average, some will use other moving averages in between, and all we really need to know for the purposes of these lessons are the 20, the 50, and the 200-period moving average. These are the ones that I've found work the best and most often for the type of trading we do and the type of trading that I teach. When we look at the moving averages, you think of them in terms of slow, medium, and fast. For example, the 200-period moving average on this chart would be the slower moving average, meaning it takes longer for a 200-period moving average to move up and down with the market as it does as compared to the 20-period moving average, for example. Meaning, when you see a 20-period moving average, it's tracking 20 periods or 20 candles or 20 bars in this example. The 50-period moving average is tracking 50 candles, and the 200-period moving average is tracking 200 candles. And that's why you see one being slower moving, the 200-period moving average, against the quicker moving or faster moving average, which is a 20-period moving average. The way we use the moving averages is fairly simple. We use them as a guideline. For example, the 20-period moving average, the market will not stray away from the 20-period moving average very far. And when it does, it will usually snap back to trade toward the 20-period moving average. So there are times when the 20-period moving average is more important than other times. For example, when you see the market trade in and around the 20-period moving average back and forth, the moving average, or any moving average for that matter, it has less importance. When the market goes up and down, back and forth through the moving averages, they have less importance. They're not as important as they would otherwise be if the market was away from the moving average, potentially trading back to it. Trading back to a moving average after it hasn't been there in a while can act as a resistance or a support level. But when a market trades back and forth through moving averages, they have less importance, so they're really not considered support or resistance as depicted by the two oval circles on the chart. However, other times when the market does trade away from the moving averages, as they get farther away, we begin looking for areas on the chart where a support level, like in this case where the market was falling away from the moving averages, we begin looking for support levels, understanding that at some point in time when the market does find support, it will tend to trade back towards the moving average, which I like to call, in the case of a 20-period moving average, home base. The market likes to trade in and around home base, which is the 20-period moving average. So as you can see, the market found a support level, giving the 20-period moving average a chance to catch up to the market, allowing the market to come back toward home base. We also use the moving averages as an indicator of a bullish tone or a bearish tone to the market. Once the market gets below or above the moving averages, we can look at the market as in a bullish or a bearish position. For example, up here you see how the market was still trading in and around the 20-period moving average, which makes it less important to the market. However, right above it, the blue line is the 50-period moving average, and the market was staying beneath the 50-period moving average, therefore staying in a bearish position. Of course, we use the moving averages as a guide, and along with all the other technical indicators that you either have learned or will learn throughout this course, and it's one component of many that we use to put together the pieces of the puzzle in order to give us the best and clearest picture of where the next likely move in the market is going to be. More often than not, the 50-period moving average will either be a resistance point to the market if we're trading below it, or a support level of the market if we're trading above the 50-period moving average. And then, of course, there are times when we're going to be trading either above or below the moving average, and the market's going to want to get either above or below the moving average. Here's an area where the market was in an uptrend, came into the 50-period moving average, and fought its way through. Once it got above and closed above, and when I say closed above, I mean on a 10-minute candle or whatever time frame you're looking at, it could be a 60-minute chart or a daily chart, when the market gets above and closes above, closes a candle or two above the moving average, it's generally working its way into a change in direction. In this case, we're moving from a bearish case where the market moved down into a bullish case where the market was moving back up, recapturing on the upside the 50-period moving average. So the faster moving average, which is the 20-period moving average, tends to be closer in proximity to where the market is. It's home base. The 50-period moving average, the blue line, tends to be more of an indicator or an indication of a bullish or bearish tone to the market. Above the 50-period moving average, the market is more bullish. Below the 50-period moving average, the market is more bearish. And that's how we use those two as a guideline to the market. The 200-period moving average is a much slower moving average. Therefore, the market will tend to respect a 200-period moving average more so than the 20 and the 50. And when I say respect, what I mean is it tends to be more of a longer-term support or resistance point. As you can see here, when the market came into the 200-period moving average, it respected it in terms of finding support and trading around that moving average for a period of time, providing a reasonable trading opportunity when it did get to the 200-period moving average. As it came into it from above, you can see how the market found support at the 200-period moving average and bounced off of it several times, traded in and around that 200-period moving average before breaking down further. So inside this circle is a really good example of the three moving averages. The market traded above the 200-period moving average for a while, and it came into it but found support at the 200-period moving average. It traded back and forth in and around the 20-period moving average, which is the red trend line, which is also known in my world as home base, and then finding resistance at the 50-period moving average. As you can see, the market tried to rally up to the 50-period moving average, but failed and was rejected, therefore sending the market lower. Hence, below the 50-period moving average, the market has a bearish bias to it. And certainly, once the market got below the 200-period moving average and stayed below, the 200 period moving average, it had more of a pronounced bearish tone to it. So these are guidelines that we use in conjunction with all the other technical factors that you have learned or will learn throughout this course. You will see the moving averages on the charts from this point forward for the rest of the course, and we will use them in discussion along with all the other technical factors that are discussed throughout the course. All charting platforms should give you the ability to adjust moving averages to your liking, meaning the type of moving averages that you want to see on your charts. Again, they're the 20 in red, the 50 in blue, and the 200 period moving average in black.